Welcome to Key Points for January. This month, our take on increasing COVID infection rates and the development of vaccinations, what this means from an economic perspective, and our take on the financial markets as the year gets underway. Now, to the first point, unfortunately, COVID infections are continuing to surge globally. In particular, the United States and in Europe, we're seeing significant spikes higher. Now, this is resulting, certainly in the case of Europe, in governments implementing new lockdown measures in a bid not only to try and contain the spread of the virus, but to make sure they protect their health service systems, which of course have been coming under increasing strains and pressures. Now, unfortunately, we don't see any quick change to this. The likelihood is that these lockdowns could last for a number of weeks and months going forward until the vaccination program really gets into full swing. And on that front, it should be no surprise, we are seeing some operational logistical issues in terms of getting these vaccines out. The good news is more vaccines are being approved, but of course the challenge is to get them widely available in a quick and timely manner. And that's where we still think there could still be some slippage. And as a result of that, that's going to put some pressure from an economic perspective on the first quarter this year. Which takes us to our second point. Although we believe that economic activity will be very strong in 2021, with growth globally significantly above trend, we are a bit below consensus in terms of our actual forecasts. And that really is based around the first quarter of this year, where we can see some of these COVID-related challenges, meaning that economic activity might disappoint. The lockdowns will, of course, contain actual activity levels themselves, but it will also potentially impact a bit of sentiment. And even although we think that that can recover fairly quickly once the economies open up and mass vaccination becomes available, there's no doubt it will dent the first quarter of this year from our opinion. Now, what does this mean from a financial market perspective? Certainly, 2020 closed on a very strong note. The MSCI World Index was at a new record high. The tech-heavy NASDAQ index was up over 48% in the United States, despite the fact that we were still in the midst of a global pandemic with the worst recession really in the last 100 years. Clearly, the stimulus that was being applied was working. And that's something that we think will continue in 2021. These same dynamics of interest rates being held at the lower bound, additional fiscal and monetary stimulus being applied, we believe will continue to lift the risk assets of equities and credit higher. Now, of course, that doesn't mean to say there's going to be no pullbacks. We suspect there will be. But we do believe the buy and dip mentality that investors have shown for some time now remains in place, and therefore any kind of pullback in the short term is likely to be seen as a buying opportunity. Over the course of the year, we still believe both equities and credit can do well. Remember, you can read the full report as always on zurich.com/MSME.